We begin, though, with our talk of the tape, whether the Fed is about to send stocks into a tailspin by raising rates too much too fast. That is the call from some of the world's biggest investors. But is it right, and what does it mean for your money? Let's ask Dan Greenhaus. He is Solus Alternative Asset Management's chief strategist, right here on set with me at Post 9. Is that one of the issues we need to worry about today, the Fed doing too much? First, it was like they're not doing enough. Now they got serious. Now it's like they're doing too much. Some are saying that. Do you agree?
Sure. Well, admittedly, from the beginning, the risk was if you allowed, intentionally or otherwise, inflation to, quote unquote, get out of control, then the risk was that you would have to do a lot to bring it back into something resembling a reasonable level, and your ability to do that is constrained without causing damage throughout the economy. This was the argument put forth from day one by a whole host of people, Mohamed El-Arian, Olivier Blanchard, and largely speaking, that has come to pass.
Well, I mean, it's gotten louder lately, right? Barry Sternlicht today on Squawk Box said the economy's breaking hard. These are his exact words. Miserable CEO confidence. Rate hikes could spark a major housing crash, a serious recession in the fourth quarter. I spoke with Jeffrey Gundlach out in California this week. Here's what he said about what the Fed's doing.
Thanks to the thing today, I might do 25. If we had this interview yesterday, I would have said do nothing. But, I think I would do 25.
Because they haven't waited long enough to see what the impact of the hikes that they've already done are going to have.
Right, it's oversteering.
Right? They do. He wants them to do. He really wants them to do nothing after you got the CPI surprise. He said, all right, I can deal with 25 if they have to. What do you think?
This monetary policy operates with long and variable legs is a saying for a reason. Obviously, it has a more direct and immediate impact on financial conditions, a.k.a. stock prices and credit spreads, but its ability to impact the economy at large tends to take anywhere, we don't know for sure, but let's say 12 to 18 months. So underlying what I'm sure is Jeffrey's argument is that monetary policy that's been inflicted on the economy so far hasn't really impacted the economy as of yet.
It hasn't. I mean, isn't he right?
Well, housing is in bad shape, certainly in a lot of pockets of the economy. The manufacturing sector is slowing down. But I want to make a point here. I brought a picture with me. Can we throw if we have it?
Throw it up if we have it.
So Jay Powell keeps referencing Paul Volcker as sort of someone in whose path he would want to follow.
Yeah.
And I think it's gone unnoticed by the market. In his speech in his speech in Jackson Hole, he mentioned how he's going to keep at it. Two times he said he's going to keep at it. He spoke to Cato Institute the other day, and one of the last things he said was he's going to keep at it. This is the title of Paul Volcker's book, called Keeping at It. And I don't think this is an accident.
No, he mentioned Volcker specifically.
Yes.
In Jackson Hole.
He's mentioned Volcker. I don't think the market is giving credit. When Jeffrey says he should raise 25 basis points, and there are other people who make the case, not without merit, that they should sort of slow down, this is an important point that Jay Powell is both consciously and subconsciously trying to send to the market.
Well, the point is that Volcker, when he raised rates, he kept them high for a long time. The Fed, for all intents and purposes, has just started on this raising rate thing, right? QT has just really gotten going.
And hasn't really. I mean, because the way Treasury maturities work, it's not really until today when you're going to see, if you do, and I have to check the maturity schedule, any serious roll-off of the balance sheet. But yes, it is accurate to say that Paul Volcker raised rates, well, the second time, raised rates and left them there for a while. That's what's presumably going to be the case now, because even if the Fed gets up to call it 4 or 4.25% by the end of this year, the CPI, which isn't their preferred measure, but the CPI is probably still going to be 5 to 6% or so. You don't even have the Fed funds rate above the inflation rate,
right,
which is something that a lot of people believe that you need to do.
So then what does this all mean for the person who's sitting there watching, wherever they're watching? What does it all mean for stocks? Because I've got Ray Dalio today comes out and says if rates rise where they are to about 4.5%, you got a 20% negative impact on equity prices. Scott Minerd last week in overtime right here was suggesting you could get a 20% decline in stocks by mid-October. I asked Gundlach directly about that. He's like, yeah, I agree with that. 20% sounds right. I don't know about mid-October, but he's got a target of 3,000 on the S&P 500. Is that what we need to start worrying about? Like declines of that magnitude?
Well, first of all, I don't know Ray or Jeffrey, but I know Scott, and Scott I think the world of. I would put myself in that camp, and I've been making that case with you for 6 or 9 months now. we're probably going to test the lows, and we will probably make new lows somewhere in that 3,000 to 3,500 range. Why? The answer is, as we discussed earlier, you haven't seen the broad-based economic weakness nor profit weakness that's probably going to materialize later this year and early next year, the combination of which will probably necessitate an additional decline in stock prices.
This is the